welcome to the Market Capitalist. I am Domenico Johnston, and today I want to talk about commodities, futures, and inflation. In the news lately, we hear a lot about inflation and how people are predicting that it's going to impact us negatively in the future. And by negatively, I mean that inflation is going to increase and the value of your portfolio, though it might be the same or greater, it's going to have less buying power. And really, that's what we're after, right? We're investing to increase our buying power. So, how do commodities in the futures market impact you as an investor in terms of hedging against inflation? Well, I'm here at a feedlot with some cattle and they're eating grain, they're eating hay, they're eating almond hulls, they're eating a number of commodities here. And each of those commodities is really the first instance or the first step in the production process. In this instance, they're feeding cattle, which are going to either be milked or go to slaughter and be consumed by you and I. Well, because it's the first instance of the production process, this really is the first step of where inflation starts to take its toll on the economy. And as an investor, if you're going to hedge against inflation, you want to hit it on the ground floor so that you really do protect yourself. Now, obviously, we're talking about grains, we're talking about corn here. There's a number of other things. It could be oats, it could be natural gas, it could be a number of things. Commodities, think of commodities in general as raw materials. So, anyways, getting back. Okay, so you're thinking of how to protect yourself against inflation. One of the main avenues you could do this through is to the futures market. And I'm going to talk about the futures market, and don't get scared. You don't have to go out and directly invest in the futures market here. I just want you to understand the concept so that when you do start investing in whether it's funds or whatever the method is to hedge against inflation, you know kind of the background of what's going on. So the futures market. Let me give you an example. I'm an investor. I'm worried about inflation. I think that inflation is going to, be really prevalent in a year, and I think corn's going to be one of the main, not benefactors, one of the main industries that's going to be hit by inflation. So I go onto the futures market and buy contracts for corn for a year from now. So I'm locking in a price for corn, whatever the measurement unit is, but it's in 1 year from now. So I have that price locked in. Now, 6-8 months pass, and guess what? We do see inflation hitting, all commodity markets, but particularly corn in our model here. So what's happening is the price of these contracts is increasing significantly because inflation's happening. Now, what can I do? How does this help me as an investor? Well, the contract that I bought a year ago is going to be a lot more, not necessarily valuable, but a lot more highly priced because of that inflation is factored in there. So I can take my contract, find either a speculator or an actual farmer on the market, and sell that contract to them for the higher price, and thus protect myself from the inflation that happened. So what exactly happened here? I bought a contract for a year out. My assumption came true. Inflation started to increase. Because of that inflation, the price or the value of my contract started to rise because the market is pricing in that inflation. And therefore, I hedged myself against inflation because I was able to sell that contract to somebody else for a greater value than I bought it at. Now, as an investor, you're sitting here thinking, that sounds great, but I don't have that knowledge level. I don't have the time to go out and invest in futures markets. That's fine. There's a lot easier way to do this. And you can do it through exchange-traded funds or mutual funds. They're set up to allow you to get exposure to commodities, but not have to actively invest in them through futures markets. So you can go out and you can buy an ETF that is specifically set up for a natural resource like oil, natural gas, whatever it is, energy resources. Or you can do one that has farm-based commodities in it. And the same thing for mutual funds. The difference between the two, as we've talked about in previous video blogs, is that the ETF is not going to be actively managed. It's probably going to be set up to follow certain general rules, so you're going to pay less as far as the management fee. and the mutual fund is going to be set up to be actively managed. So you're going to have somebody that's actively managing, making decisions on that, but you're going to pay a higher management fee. In any case, I'll leave some links below this video blog to help direct you in investment ideas in terms of ETF and mutual fund commodity-driven funds. So that will help you out there. But just to recap on what we talked about today, commodities. They're the first input in the production process, which means they're often the first thing impacted by inflation. If inflation is going to rise, they're going to feel it first. Thus, that's where you want to go to hedge your bets against inflation and protect your portfolio. Secondly, the futures market is where it really happens, where you can actually, it's the mechanism to protect yourself against inflation through commodities. It's locking in the price of something in the future at today's date. And lastly, mutual funds and ETFs provide an easy avenue for people like me and you to hedge your bets against inflation through commodities. Again, thank you for tuning in. I hope you found this informative. If you have any comments or questions, leave them below. Thanks again.